Hello, everyone. My name is Robin Dolezal. Today is Tuesday, August 2nd. With me, as always, are Dan Nentel and Alex Pars. Together, we are with Ironwood Financial. How are you, gentlemen?
Good, yourself?
Good. I don't know. Did I say good afternoon or good morning? I guess we're in that midway point. It's hard to tell, but good morning.
Good morning.
Yeah, I know we've done a couple market update, guys, but it's been a couple months since we did our video last. You guys enjoying your summer?
Yeah, it's over.
I know.
It starts next week.
Yeah. It flew by.
Well, it's worse here, I think, because growing up in Minnesota, my dad, you wouldn't start school till after Labor Day.
Yeah.
Right.
And I remember my dad always had this saying, it was once the 4th of July hit, he'd always like, summer's over. And it always drove me nuts. I'm like, no, it's not almost over. Well, in Arizona, it is almost over once we hit 4th of July.
Yeah.
That's because it'll get cool in the end of October.
Yeah, that's true. Anything exciting? Dan, I felt so bad. Usually you work from, Minnesota for a while. You really cut it short this year, didn't you?
Yeah, this year was, as you two will experience as the kids get older and work and have mandatory sports, the summer little getaways, work remote goes away. So good problem to have.
Yeah, it is. All right. Well, either way, it's good to see you too. We've got a lot to talk about. A lot has happened this year. Let's first start, obviously, because this is probably what's on most people's minds, is we finally have a technical recession, right, Alex? I mean, I think it's going to be a while before the National Bureau defines or just says we're actually in a recession, but we have what now, two negative quarters?
2 negative quarters of GDP growth, which is what I always think of as a recession. I think they're trying to avoid saying that word this time. And to be fair, does it feel like a recession? The answer is, for most people, no. I mean, when you think about recession, and this is what's been going on in the media, is people have been throwing that word out there trying to scare people. And when you think recession, you think the Great Recession, when there's 4 years of unemployment over 10% persistently for a long period of time, and you can't pay your bills, people getting foreclosed on. That's not where we are. Okay, right. We still have, I think, 12 million unfilled jobs. 4.5 million people are quitting their jobs every month because they know they can get a better job like that. And so this, while maybe a recession, it's not going to feel like any other recession, and think of it more as just a slowdown.
Yeah. Well, I mean, I just kind of term it as a technical recession, but yeah, I mean, it seems like all the other factors that they look at are doing pretty well. I mean, the economy's doing pretty well. So yeah, these GDP numbers is about all we've got so far. So, but we also have inflation, right? We're still battling that this year. The latest numbers, which came, I think, were as of the end of June, we're at what, 9.1%.
And more importantly, 1.4% per month.
Yeah,
I think it was. So that's a pretty nasty number if you multiply that times 12. And again, the question is that going to persist? And that's really the big worry on everybody's minds. And I think we've probably peaked. I mean, not necessarily on that 9.1 number, the headline number, but on the monthly number. Because again, think about how you feel today as opposed to how you felt back in November. Okay. If you were riding high on the hog with all your crypto earnings, you're not anymore. If you were feeling awesome about your meme stocks, well, sorry, that ship has sailed. If you're looking at how much your real estate was appreciating, well, not so much anymore. Mm-hmm. And if you're also looking at all the free money you're getting from the governments, that's also gone. Yeah. So all of those factors are leading towards, I think we saw, is it Walmart and Target both said, the consumer's hurting, they're starting to pull back on their spending. That's going to lead towards lower inflation. So the good news is probably that 1.4 per month number is probably the highest, I hope, that we see, and we'll start to see lower numbers going forward.
How long do you think it'll take for us to see the effects of what the Fed is doing to combat inflation?
Some of it is relatively quick, but historically they said it takes 3 to 6 months to even start to see the effect of a rate hike, which means that we are now feeling the March rate hike maybe. Okay, so remember it was 0.25 0.5, 0.75, 0.75. Well, we're starting to feel the first one.
Yeah.
Okay. The last three, not so much.
Sure.
So I think the reason
but let's talk about that. So they raised it 25 basis points. Everyone felt, oh my goodness, the Fed's, what are they going to do? Slow down the economy. They raised it 50 basis points. They gave us guidance on how high they were going to go. And it would appear as though maybe the market priced it all in already. I mean, remember, they raised interest rates at 75 basis points, 0.75%. Mortgages went from 3.5% to 6%. Now, what have they done since? They've raised it 150.
You're talking the first one.
Yeah, the
So
first
they raised it 0.25. Yes.
0.25, and they've raised it now 2% since, and mortgage rates have come down.
As is
I
the
was just
10-year
looking at our
treasury.
I was looking at our bond portfolios. Back in June, our bonds, when they hadn't done the two 75 basis points and 75 basis points, our bond portfolios were down about 13%. They're now down about 8%. Yet what have they done? They've raised interest rates 2 more times. On the way in today, most of the things I heard of is they're worried that the Fed is going to be too hawkish, meaning they're going to keep raising interest rates. Now, remember in June when we hit, and again, we had a Zoom back in June, and I remember Alex kind of making fun of me because I said, I bet we hit the bottom. And Alex said, oh, don't ever call a bottom down. But, the S&P had hit about 3480, 3450. And at that point, what were they saying about the Fed? Why doesn't he just punch us in the face and give us 2% right now and stop inflation? He didn't. And in fact, as I mentioned, bonds have come closer to par, meaning they've gone up in value. What are they saying now? He better not be too hawkish. He may have already gone too far. So the markets are so efficient now that I don't know that it's true that it's a 3 to 6 months. We price it in, at least in the markets, and that's where I stand corrected.
Yeah.
In the markets, they fill it in immediately, pre-price it in, and then wait and see what happens. And so many times, and I'm not going to say it again, and we could touch the market again, the bottom, but it feels as though, and you're starting to see it more and more, that June 14th number was close to the bottom in the market and close to the bottom in the bond market.
I want to hold your feet to the fire, Dan. I want you to call it. Was it June?
Sorry, Dan's not on the next Zoom meeting, but
yeah, I mean, that all makes sense. And the hope right now is that the Fed sticks to their original plan, which is we're going to be aggressive through the July meeting. And then we really need to wait and see what this does to the economy. Again, not the market. These rate hikes are supposed to slow down the economy. We need to get rid of something like 7 million available jobs in order to get back to a place where we're not so inflationary. And so they need to see what happens in the next couple months. So hopefully, and I think this is what's driven the positive, rally in the market over the last few weeks, is, now they're hopefully moving into a wait and see approach. They'll be less aggressive, maybe a 1/4 point or a 1/2 point at the next meeting in September. And then, maybe end out the year without any more of these mega hikes.
Yeah.
So we may be over the hump.
Not only have we kind of maxed out on inflation, at least from a monthly number, we may have maxed out on Fed rate hikes.
Yep, hopefully we're over that hump too.
Pegged to June, so this is looking good, guys.
I think it's funny. The other day, Alex and I were just kind of crossing each other in the hall, and I said, "I wonder how many times he'll do 75 basis points." And I've never heard an investment professional say this. He goes, "We just need unemployment to get a little worse." Meaning we need. So I mean, it's weird how the markets think. Again, remember, the markets are not real life. The markets are saying we actually need more pain in the world so that the Fed doesn't want to keep raising interest rates, which is, again, it's a difficult dichotomy to think about. But
yeah, well, and the Fed did predict unemployment going from something like 3.5 to low 4s in 2023. So that is basically their goal. They're trying to drive up unemployment. Which
right, so let's then segue into how this has affected the market. So I think as of this week now, the S&P is down 14%. July, did you see July numbers?
Yeah.
For the S&P, gosh, a nice rebound of 9%. What about, talk to us, Alex, because everyone wants to know what's going to happen in the market. Where are we at, and how are you gauging where the market's at, and what do you think is going to happen in the second half?
So, I said very cheekily that I think the second half will be better than the first half, and people are like, "Oh, that's a low bar." But I stand by that at the moment. I think our bonds, again, as Dan had mentioned, probably have bottomed, and that's because they priced in all those rate hikes back in March and April. So they've started to grow as well as pay interest. So that part of the portfolio, I think, is actually just going to see a nice uptick over the next yearish. Okay. The stock market, I would say, probably, again, as Dan mentioned, probably has bottomed because we're over the hump on the Fed rate hikes, hopefully. Hopefully the next inflation reading is something like 1.2 or 0.9 per month. Again, 1.4 per month is pretty high. So that's, again, not a very high bar to beat that number. So all we need to do is beat that number, and people can say, look, it's working. That means the Fed can be more conservative and the stock market will be happy.
Right.
So those two factors, along with PE ratios, and this is one of the important things we follow, which is PE ratios as of a month ago were 15 and change for the S&P and 10 and 11 for small caps and mid caps. To put that in perspective, for smalls and mids, that's the best PE ratio we've seen since 2009. So really a great number in terms of relative value for the stock market. It's very, very inexpensive for smalls and mids. And then large caps are right on with, typically historical averages. So we are no longer overvalued, assuming profits hold. And so far profits have been holding. And that's really what we need to watch next is, can companies continue to make this level of profits amid this tightening cycle?
Yeah. Well, and I think it was something, I just wrote that down. 73% of the S&P 500 companies that reported second quarter were doing really well.
Yeah.
Which, again, as someone who's kind of more forward facing with us, I've been getting those calls and emails saying, gosh, and should we, unfortunately, it always happens near the bottom. It's almost, you could peg it when you start having clients wanting to go to cash. That's normally when we've been at the bottom. And that's obviously very anecdotal, but based on what you just said, relative value is good. And relative value historically means we should be buyers, not sellers. Or we hold. Same thing's true of our bonds. I mean, right now, if you wanted to go out and you built a 3-year bond ladder, no more than 3 years, you're only going out to 2026, and you're kind of intermittently using some high quality with some high yield. I mean, you can get 5.5, almost 6%. I mean, that's a pretty good yield that history tells us back in 2000 is a nice hedge against a bear market. It really protected us in 2000. What it didn't protect us in as much in 2008. Why? Because they printed money and lowered interest rates. I've said this term, the Great Reset may have happened, meaning bonds might be somewhat attractive again going forward, and maybe the stock market is a relatively good deal. Does that mean it's going to be a good deal next month? Have we touched the bottom? Who knows? Could we touch it 3 more times this year? Absolutely.
That's true. However, I keep saying this, last year when interest rates were 0 and the stock market was overvalued, the saying was, close your eyes, hold your nose, and buy stocks, because that's the only game in town. Now there's another game in town, but the stock market's actually a good price. So if we buy at this level, it's not a bad deal. It's not, oh my gosh, I can't believe I'm buying this. It's, hey, this is actually a pretty good deal. Maybe it's not the best deal I'm going to find, but it's certainly a better deal than it was 6 months ago.
Right.
Well said.
Yeah. Well, I think we hit it. I think we hit them all. Anything else you guys can think of that we need to address?
No, I'm going to throw our little disclosure thing up here.
Okay. As always good to see you guys. Folks, if you're watching this and you have any questions that we did not address, please don't hesitate to reach out to us. If you have any questions about your specific situation, you can do that as well. You can find us at ironwoodfinancial.com, or you can call us toll free, 888-271-4646. Other than that, you will continue to see our market updates, and we'll do another one of these shortly. I hope you guys have a great afternoon, and I will see you at the next one.
Take care.
Thanks, guys.